Okay, the cumulative delta, that goes without saying, that's your cumulative delta on the base. So what we can see is, as soon as the cash session opens, high delta. Okay, very, very nice high delta. What I typically use on all of my charts is not a lot of squiggly lines. Okay, what I typically use is a lot of Bollinger Bands on my delta in particular. In other words, I don't care about normal delta, what I care about is outlier delta. I want to see a lot of a buyer coming and lifting very big offers. That I'm interested in. I don't really care about the minute stuff. I don't care about flat delta. That doesn't mean anything to me. Okay, so I want to look at outliers. Same thing with volume. Okay, I'll use Bollinger Bands on my volume so that I can see when there's excessive volume in the market. Okay, because excessive volume, and this is something you can go look at, a little secret of the pros. When you've had a trend line move like that and the market has moved into sort of oversold territory, what you'll typically see at the point of reversals, you'll see a very high amount of volume at the end of the move. Why? Because that's when everyone throws in the towel. That's when the stops are finally triggered, and that's the time to fade it. Surprise, surprise. Okay, so again, another strategy you can go and look at. The point is when you start to observe volume in this framework, you're going to start to notice certain patterns existing. Okay, by the way, also with regards to this, and why this is such an important sort of exit strategy, by the way, when we talk about targets, this is something to use for targeting, is that when a market has moved in a direction a significant amount, that flush is usually a very good time for you to take profits, get out, okay? Because everyone else is about to get out. If the market's moved 1%, every short-term player is about to exit the trade. So why do you want to wait for it to pull back? Exit then, you can get back in the trade if you want. Okay, so you can use these patterns not just obviously in this strategy, but you can also use them across different strategies. Okay, it's just different principle understanding, that's all it is. Now, let's get back to the strategy. So we got cumulative delta, we've got the high delta, the starting point, okay, the buys, that first bit of buy lifting nice big offers, and we've got relative volume. Now these blue bars, by the way, is average volume at that time effectively over an average number of days. Okay, I would say, again, if you're a day trader, and depending on what time frame, I don't want to give you a rule of thumb, but you want to apply either a short moving average, okay, if you're using a very low time frame, if you're using a very high time frame, and a very short moving average if you're using a much higher time frame. Okay, so for example, if you want to see the average volume of the last, or if you want to see average volume on a daily time frame, I'd say use something like an average over 5 days. If you're using 1 minute, use average volume over 20 minutes. Okay, it's going to give you a good amount of understanding as to what the data is doing. Anyways, okay, so what we've got is we've got our trend-like move. So we've got our price change, we've got our volatility, we've got our structural break, because we can obviously see we've now broken out of weekly highs. Market extends itself, so we've got that trend-like move, and we then get our fib retracement on. We can see our 25% there. Now, market comes back and gives us a long-tailed axis candle. Now note, what is the volume doing here? Okay, whilst it's low, it's high relative to the time frame. Okay, and this is again where you have to be very careful with failure and nuance and how you define certain things. But in essence, what we've got is we've got an axis candle, but is it an axis candle given the amount of volume? Okay, that is up to how you interpret different axis candles. Anyways, at that point, market obviously does find some form of a bounce. I'm just going to erase this so I can draw a nice line there. We then get the market selling through. Now I said to you there's two opportunities to this trade strategy. If we entered on this axis, okay, where are we entering? We're entering around the close of that candle. You can all see this where this green line is. Okay, we're entering around the close of this candle. Okay, so where's our stop? Our stop is below the axis candle, and what are we targeting? We're targeting the upside. Now again, in terms of risk reward, this looks very much just over 1 to 1. Call it 1.2, 1.3 to 1. Okay, so not great risk reward, but sufficient. Okay. At that point, however, we stopped out of the market. Now here comes the key. Axis number 2 is once we get a confirmation close. So confirmation close is what I explained to you with regards to the pound sterling. When the market confirms a close below a certain price point, at that point we have access. Okay, so once the market has settled below the previous access candle, we then have a secondary signal going off. Okay, at that point, again, where are we selling? We're now selling again very aggressively. Where's our stop? Above the access candle, and we then have exposure again to a full retracement. Okay, so failures of delta accumulation strategies will offer a better risk reward play. Why? Because we need to see an unwind of all that short-term positioning in the market. Okay, so yes, we failed and lost on the first opportunity. However, on the second opportunity, we made back our losses and a little bit more, not much more. Okay, in terms of target, you would typically target a full retracement of the range, so somewhere around there. And again, notice what happens in terms of price response. For a good hour, we can see a lot of two-way trade. So we can see liquidity coming back into the market. Okay, now what I would say to you, and again, this is where strategy characterization comes in. You are going to learn through strategy characterization to determine how you enter the market, where you place stops, should you preempt, should you not preempt, what should your targets look like. But what you will find on a lot of trade strategies, remember what I said to you in terms of volume, notice what we see in terms of this candle here. Not only do we get a very high volatile move, but we also get a significant, almost tripling in volume. Okay, so 3 times almost what we're trading in the average, whatever, hour and a half session. Okay, and that is that stop run. That is those short-term players stopped out of the market, and that's at that point we want to just exit the trade. Get out of the trade. You've made back your losses and maybe scraped a little bit of a profit on the day. Step away. Okay, don't forget what our objective is here. Yes, we want to win. Yes, we want to make money, but some days we have to accept that it is just about scraping back losses and getting back to zero. Okay, that's the first example. Again, second example. This is nice in textbook. Straight off the open. Okay, note this is FOMC day, so again, risk events. The Cumulative Delta Strategy works well. Why? Because we typically see trend-like moves after big risk events. Okay, whether it's FOMC, whether it's key data points. Remember what I said, a lot of institutions will wait for the risk and then put trades on. Okay, so if you do see very big structured breaks of very big levels over a key risk event, you've definitely probably got this play happening. Okay, so just keep a close eye on that. Now, what you can see, obviously, we have a nice trend-like move. Again, we've got our excessive delta, we've got our accumulation, we've got our break of not just daily but also weekly highs, and we can see volatility within price. At that point, market comes back, pulls back, and what we can see is, oh God, I need to learn how to draw this, 25% retracement. Okay, again, notice how the market trades through. Right, so just in terms of volatility, that's probably around a 7 handle push through. Okay, so again, if you're going to preempt, you have to accept that you are preempting and you're hoping there's going to be liquidity behind you. All right, if you are waiting for access, which is, what is the access here? Notice the high volume counter trend delta. Okay, again, that doesn't look like a lot because I tried to include that, but that's a good almost 4,000 contracts of sell side absorption. Okay, so someone was very, very happy to step in and start providing bids. Okay, that for me is sufficient access, and at that point you then get your bounce. Now again, does this picture perfect go back to the high? No, of course it doesn't. The session closes. Do I want to carry risk overnight? No, of course not. Right? The reality as a trader is I'm not going to trade this through the night. You know, it may just have been a case that you're getting out there and you accept that you're taking one-to-one risk. Right? So sometimes, and again, this is why rather than point and say, oh no, you just traded back to there, it doesn't work that way. You've got to trade actually how the markets trade. Right? In this instance, you probably would have done well to get one-to-one risk reward out of that trade. Okay, but a nice textbook example. Another example of it, again, we can see our cumulative delta. Again, we can see our price directional trend, and I'll come to this in a moment, the 3s and the Vs and all those wonderful things. We can see our extreme amount of delta. And again, in this instance, we get our retracement. Note the market does respond. So initially we do get the retracement, the market responds to it. We can see a very nice long-tailed sell candle come in, access, and straight away what does the market do? Next candle is an up candle. Now again, this is a bit of a nuanced feature. You don't really want to see the market suddenly start making higher highs when you expect only sellers to come into the market. Okay, it has a second retest of it, and then what does it do? And this is key in terms of observation. What does it do for almost 45 minutes? It hangs around the point where the sellers entered. So for a good 45 minutes, it's sending you enough signals to say, you know what, be careful here. It's not as strong as you want the selling to be. Okay, at some point then, we have the confirmation close. So we close above our key level. Market comes back, retests one last time, and then unwinds all the positioning. Okay, so yes, probably didn't make any money, small little loss on this. You probably would have been stopped out somewhere over there. Again, sucks, you would have lost money, you would have probably been entering somewhere around there. And again, you're looking for that stop run. If we go in terms of the extreme delta, I haven't got the volume on this, but you probably would have been getting out somewhere within there. Okay, so again, What you've lost there, you've probably made that back and maybe a little bit. Okay, probably a break-even type day. Okay, and then a nuanced example. As you can see, again, cumulative delta. Market does have a nice sell-off, a nice extreme sell-off, and you'll notice, by the way, the date on this is this week. Okay, so this was the S&P on Wednesday, Thursday, a lot of signals going off, very good opportunity. The only problem is, the market didn't give a fill. Okay, it was that aggressive, the sell-off was that aggressive in nature that the market actually didn't retrace sufficiently. It did go and retest, it did extend overnight, but unfortunately it didn't give any kind of an opportunity. And I mean, again, in terms of volatile conditions, it's a 25 handle move. Okay, 25 handles is a pretty penny for most traders. Okay, so go have a look at this. The dates in terms of, let me just quickly give you the dates so you can go look at this in greater detail. Those are your 4 dates. 9th of Jan, 1st of Feb, 23rd of Feb, 9th of March. Okay, 4 of these in the S&P so far this year.